This is the Daily Market Comment by Rafi Boyajian. I'm Maria Bashardis. Thanks for joining us at XM.com. The US dollar was struggling to hold on to its weekly gains after falling sharply on Thursday on the back of the slide in Treasury yields. The retreat in long-dated yields comes after President Biden said his $2 trillion infrastructure plan would be paid for entirely by increases in corporate taxes, alleviating fears that the massive spending would stoke inflation and overburden the U.S. economy with debt. The dollar is on track to finish the week with only marginal gains, but could get a chance to bounce back later in the session if the March non-farm payrolls report, due out at 13:30 GMT, smashes expectations amid some predictions of a bumper month for America's labor market. Although the scope of Biden's proposed tax hikes was far greater than what many investors were anticipating, the infrastructure plan should nevertheless provide a substantial boost to the U.S. economy. This could be one explanation as to why equity traders appear to have taken the planned corporate tax increase from 21% to 28% in their stride. But a more likely reason is that markets think it will be difficult for the Democrats to push ahead with big tax hikes, given the scale of opposition by the Republicans, as well as many business groups. Yesterday's upbeat manufacturing data has added to the optimism about the recovery, while softer than expected weekly jobless claims have eased fears about an overheating economy that would prompt the Fed to start tapering early. Stocks reveled in the optimism, with the S&P 500 soaring to record highs to close above the 4,000 level for the first time ever. With stock markets across Europe and North America closed today for Good Friday, FX markets were in a calm mood. But in commodities, oil posted a surprise reversal on Thursday, jumping by more than 3% after OPEC and its allies announced a gradual lifting of output quotas. OPEC Plus producers decided to keep April output at March levels, but raise it by 350,000 barrels per day in May and June, and by a further 450,000 barrels per day in July. Judging by the reaction in oil markets, investors are betting that demand will recover strongly in the second half of the year and more than offset the planned increases in supply. This is today's Daily Market Comment. Thanks for joining us at XM.com.